Have you ever looked at a stock chart and felt like maybe you're only seeing half the story? Most investors, myself included sometimes, we focus so intensely on price, where a stock has been, where it might be going. But what if there's this crucial, often neglected piece of info that really reveals the market's underlying intentions, the conviction behind the moves? Well, today we're unlocking that secret. We're taking a deep dive into a really powerful book, Investing with Volume Analysis: Identify, Follow, and Profit from Trends by Pelz Dormeier. This isn't just about the outcome of market activity, like where the price ended up. It's about the force and, well, the conviction driving it. You want to understand markets quickly, thoroughly right. And this deep dive is custom tailored to give you those aha moments. We're cutting through the noise to get to the core stuff.
Indeed. And it's interesting, as Tom McClellan, editor of the McClellan Market Report, points out, for every single stock trade, there are really three key pieces of information recorded: price, time, and crucially, size. So if you're only looking at prices, you're basically, well, throwing out a whole lot of key information, as he puts it. Buff Dormeier, who's an award-winning industry innovator, a chartered market technician, he argues pretty passionately that this size volume is an equal, completely indispensable partner with price if you really want to understand market movements.
Okay, right. Let's break this down then and figure out how volume actually acts as the market's polygraph.
Mm.
So many of us, we instinctively just look at price charts. It's visual. It seems straightforward. But why is relying only on price maybe insufficient? What unique dimension does volume really bring to the table?
Well, price represents a consensus, right? It's what people are ultimately willing to pay or accept for a stock at a given moment. But volume adds that crucial depth. It adds meaning to that consensus. Richard W. Arms Jr., he notes that Dormeyer really recognized volume as an equal partner with price. And it makes sense because volume helps validate price movements. Think about it like this. When a stock's price is rising, but fewer and fewer investors are actually participating, the volume is decreasing, that fundamentally contradicts the upward price move.
Huh. So it's like throwing a party, but nobody's really enthusiastic about coming.
Exactly. It signals an underlying weakness, almost a lack of conviction behind that move. It's fragile, and you can even connect this to the bigger picture. Benjamin Graham, the father of value investing, he famously called the market a voting machine in the short term.
Right, the voting machine analogy.
Yeah, and in that analogy, volume is quite literally the ballot box. It shows the sheer power, or maybe the lack of power, behind the forces of supply and demand that are actually driving the prices.
Okay, I like that. So if price is the market's testimony, what it's saying, then volume is its polygraph, revealing the truth, the real conviction behind those statements. That's a powerful idea. That historical perspective is really interesting. Market analysis having this sort of back and forth history. So technical analysis, including volume, wasn't always mainstream. Why was that? What was the resistance?
Well, you can trace modern technical analysis way back to Charles H. Dow, co-founder of the Wall Street Journal. Back in his day, late 1800s, financial information was incredibly scarce, and frankly, it was often manipulated.
Right, not like today with data everywhere.
Not at all. So just observing market actions, prices, volume, the trends, that was the essence of technical analysis. It was a vital way to gain insight when the company fundamentals, the actual business details, were often hidden or, well, unreliable. But then the mid-20th century saw this big shift. Benjamin Graham and David Dodd's huge work, Security Analysis, really popularized fundamental analysis. It pushed everyone to focus on a company's intrinsic value.
Underlying worth.
Exactly. And the SEC even brought in a rule in 1949, basically mandating that all research on Wall Street has to be rooted in sound fundamental principles. So universities started prioritizing fundamental analysis. Technical analysis kind of got pushed to the side for a while.
So did that just discredit technical analysis forever?
Yeah.
Is that the end of it?
Oh, not at all. It kind of went underground for a bit, but it never disappeared. And then a really interesting 1998 Yale study came out. Stephen Brown, William Gutzman, and Alec Kumar, they reevaluated the work of an early Dow theorist, William Peter Hamilton. And they found that his technical application, his methods back then, actually appeared to have yielded positive risk-adjusted returns.
Wow. So it worked even back then.
It did. And it highlights this key point. While fundamental analysis is about the what's the company worth? Technical analysis, with its focus on the when and that human element, the psychology, it's equally vital.
Okay, so volume fought its way back into the mainstream, deservedly so. Let's get deeper into what it tells us. Beyond just confirming price moves, what specific insights does volume offer you, the investor?
Well, volume is just this incredibly rich source of information, really. First, as we said, it validates price. More shares traded at a certain price level means more votes, more agreement on that price. Second, it substantiates information. Like if big news comes out, does the volume pick up? That confirms the market sees it as significant. But maybe most importantly, volume truly reveals convictions.
Conviction. How so? Can you give an example?
Sure, think about this. It's pretty relatable. Imagine you hear a really renowned, famous investor bought a certain stock, and based just on that headline, maybe you jump in and buy 1,000 shares yourself.
Okay, happens all the time.
Right? But then later you find out they only bought, say, 100 shares, just a tiny position for them.
Ah, okay. My view would definitely change.
Exactly. Your view changes because their conviction, as evidenced by the small size of their trade, was actually quite low. Volume exposes that kind of thing. Even if a stock's price isn't moving much, maybe it's just drifting sideways, a significant increase in volume can suddenly reveal large institutional trades happening under the surface. It shows real conviction building or maybe distribution starting.
So it's like seeing the actual effort behind the market's movements, the commitment, not just the surface ripples. That's a really useful distinction.
Precisely. And Richard Wyckoff, another early 20th century market guru, he had this law of cause and effect.
Yeah.
Basically, it stated that the extent of a market move, how far it goes, is proportional to its cause, the energy built up beforehand. For volume analysts, the difference between the bids and offers, essentially, that supply and demand imbalance, that is the cause of price change. And what's really fascinating here, and maybe counterintuitive, is that volume often leads price. It can signal changes before they become obvious just by looking at the price chart alone, especially when volume hits extreme levels, high or low. It's often a forward-looking clue.
Leads price. Okay, that's huge. So now that we get the general power of volume, let's zoom right in. How do we apply this lens, like day to day, bar by bar on a chart? How do we decode those signals?
Okay, yeah, let's get practical. Think of the daily price bar, the one showing the open, high, low, and close for the day. Think of that as the market's DNA.
The genetic code for the day.
Right. It contains all the basic price information for that period, but volume. Volume is like the market's RNA. It translates that DNA, that rough information. It gives it meaning, gives it context. Without volume, price is just, well, data points. Add volume, and suddenly it becomes genuine insight into the forces of supply and demand at play. So Dormeier outlines 4 basic phases or scenarios you can look for when analyzing a closing price bar. The key, always, is looking at the price action in relation to the volume.
Okay, what are they?
First, strong demand. This is your bullish confirmation. The stock closes up for the day, and crucially, the volume is higher than usual or higher than the previous day.
So more people are eagerly jumping in on the way up.
Exactly. More investors are participating, validating that upward move. That's healthy. Second, weak demand. This is a bearish contradiction. The stock closes up, maybe even makes a new high, but the volume is actually falling.
Uh-oh. So the price is rising, but fewer people are buying.
Precisely. Fewer investors are willing to chase it higher. It signals maybe complacency. It could be a warning sign that the rally is losing steam, maybe precedes a reversal.
Got it. What's next?
Third, strong supply. This is your bearish confirmation. The stock closes down for the day, and the volume is rising.
Okay, so selling pressure is increasing.
Yes. It indicates that more fearful investors are actively selling, hitting the bids. This often implies further downside is likely. And finally, fourth, weak supply. This is a bullish contradiction. The stock closes down, but the volume is falling.
So it's going down, but not many people are actually selling.
Right. It suggests that the sellers are becoming exhausted, there's apathy, maybe the selling pressure is drying up. This can potentially set the stage for a bottom or a rebound.
Okay, that framework is super useful. High volume confirms trends, low volume contradicts them or warns of exhaustion. That's a really crucial takeaway for you listening. So we've covered the basics, the history, how to read the daily signals. But how do we move from just observing this to taking, quantifiable action? This seems like where Dormeier's own innovations really come into play, right? What are some of his groundbreaking tools that help you turn these volume insights into something measurable?
Exactly. This is where we move from concept to application. Volume indicators are basically tools that keep score. They give you a numerical assessment of that volume-price relationship, and they generally act in 2 main ways. They can lead price, potentially giving you early notification of major moves.
The forward-looking aspect again.
Right. And they also confirm price, showing the conviction or maybe the lack of conviction behind an existing trend. So Dormeier developed several really key innovative indicators here. First, there are volume-weighted moving averages, or VWMAs. Now, unlike traditional moving averages that just average
Like
prices.
a simple moving average in SMA.
Exactly. VWMAs give proportional emphasis to price based on investor participation. So price points with higher volume get more weight in the average. And tests have actually shown that VWMAs improved responsiveness and reliability compared to just plain SMAs, especially for stocks that are, volatile, liquid, or maybe small and mid caps.
Okay, so it makes the moving average smarter by including volume. What else?
Then there's the Volume Price Confirmation Indicator, or VPCI. This is probably his most famous creation. It actually earned him the prestigious Charles Dow Award back in 2006 for being so innovative.
The Dow Award. Wow. So what does it do?
It directly contrasts those VWMAs we just talked about with simple moving averages, SMAs. It's designed specifically to expose that unseen nexus, that connection between price and volume. Basically, a positive reading means price and volume are confirming each other. That's generally bullish. A negative rating means there's a contradiction, generally bearish. It's primarily a tool for confirming or contradicting existing price trends.
Okay, confirmation or contradiction. Makes sense. Are there others?
Yes. He also developed the VWMSCD and the Trend Thrust Indicator, or TTI. These essentially build on that volume-weighted moving average concept, but apply it to the MACD indicator framework. Again, the idea is improved responsiveness and reliability compared to the traditional MACD because they integrate volume deeply. Studies showed that TTI, for instance, consistently increased performance across all major areas they tested.
So this isn't just like academic theory. These are practical tools designed to give you a real, tangible edge in assessing the true commitment, the conviction of investors in the market.
Okay, so these insights clearly help you spot opportunities, gauge conviction. But what about the other side of the coin, protecting your capital? How does volume play into smarter risk management?
Risk management is, well, it's everything, isn't it? It's paramount. And Dormeier introduces a really crucial tool here called the anti-volume stop loss, or AVSL.
Anti-volume stop loss. Okay, what's that? It's essentially a quantitative intelligent sell point. It dynamically adjusts based on a stock's own individual volatility. Often it uses the lower Bollinger Band, which itself is a volatility measure, kind of marking a common support level based on recent price swings.
So it adapts to the stock's behavior.
Exactly. What this does is it allows you to predetermine an objective exit level. It takes the emotion out of it, helps avoid those agonizing struggles when you're trying to decide, should I sell now? Is it going lower?
That sounds incredibly disciplined. Because, let's be honest, that's often where many of us, myself included, make the biggest mistakes, right? Selling too early, or worse, holding on too long. It seems to go against our gut sometimes.
It absolutely does. So many investors fall into that classic trap of cutting their winners short and allowing their losers to run. And this just fundamentally goes against the basic laws of compounding. Avoiding those large portfolio crippling losses is actually far more critical in the long run than capturing every single bit of upside gain.
Right, protecting the downside is key.
Definitely. You often hear that infamous missing the 10 best days argument used to push a strict buy and hold strategy. But they conveniently forget to mention that missing the worst days actually boosts your return significantly. There's analysis showing, for instance, that missing both the 40 best and the 40 worst days over a long period could potentially yield an annual return over 20%. It's about managing volatility.
Okay, that's a powerful counterpoint. But what about the modern market? It feels like a different beast sometimes. We've got high-frequency trading, dark pools, decimalization, all this stuff. Do these innovations, all this speed and hitting volume, do they distort the volume data so much that it becomes less relevant for analysis today?
That's a very valid concern, and it's a question every serious volume analyst has to grapple with today. You're right, high-frequency trading, HFT, operating in milliseconds, and dark pools, where these huge institutional orders get matched privately off the main exchanges. They certainly make the market look different. HFT can account for, 50, 60, even 70% of total market volume on some days. Dark pools are another 10, 15%. And decimalization stocks trading in pennies instead of fractions that also significantly increase the reported volume numbers.
So does that make volume useless then?
Well, here's the argument Dormeier makes, and I think it holds water. He argues that these changes, while they've definitely increased the overall volume levels, they've mostly been worked in slowly over a period of years. And for practical purposes, for short and intermediate term analysis, they seem to have a negligible impact on price movement itself. HFTs, for example, are largely providing temporary liquidity, scalping tiny spreads. They aren't typically trying to establish directional trends in the way longer-term investors are.
Ah, okay. So the noise level is higher, but the signals are still there.
Exactly. The key for you as an analyst is to focus on relative changes in volume. Look for significant volume surges, look for divergences, look for those patterns we talked about earlier. Those still clearly signal developing trends and potential reversals, cutting right through that background noise.
So if anything, maybe these modern complexities make understanding the real underlying supply and demand shown by meaningful volume changes even more crucial. You mentioned the flash crash earlier, that crazy event in 2010, as an example of market dislocation. What's fascinating here is how does that connect back to volume and liquidity? What can we learn from it?
Yeah, the flash crash connection is critical because that event on May 6, 2010, it wasn't just about speed, though it was incredibly fast. Fundamentally, it was about liquidity evaporating almost instantly when the volume became overwhelmingly one-sided, all sellers, no buyers.
The bids just vanished.
They vanished. The Dow plunged nearly 1,000 points in minutes. Now, HFTs were implicated later for maybe exacerbating it by quickly pulling their bids, but the core issue was deeper. The old specialists on the exchange floor, unlike HFTs, historically had an actual obligation to maintain an orderly market, to step in and provide liquidity. Modern market structures had kind of reduced their visibility and their compensation for taking that risk. So when panic hit, there was just this vacuum of buyers.
So it was a structural issue exposed by extreme one-sided volume.
Precisely. And what's important to understand now is that while modern markets, because of technology, can experience maybe faster drops like that, they also often enable faster recoveries. But the underlying patterns of human behavior, the fear and greed that drive those massive volume imbalances, they absolutely remain, despite all the technological shifts. Volume still shows us that underlying conviction, or in that case, the utter lack of it.
Okay, that makes sense. You also highlighted earlier the need for consistent, maybe unbiased data, especially when we try to look at the broader market, like an entire index. And this brings us, I think, to Dormeier's most advanced innovation, something that addresses a pretty significant flaw in how we usually look at market-wide volume. Tell us about that.
Yes, this is where things get really sophisticated, but also incredibly insightful. You see, traditional index volume totals, like the total volume for the S&P 500 you might see reported, are often just a simple sum, a tally of all the volume in all the component stocks.
Okay, seems logical enough.
It seems logical, but there's a problem. Price indexes themselves, like the S&P 500, are typically capital weighted. This means the larger companies, the ones with bigger market capitalizations, have a much, much greater influence on the index's price movement.
Right, Apple moves the index more than a tiny company.
Exactly. So this creates what Dormeier calls a significant disconnect. You have a cap-weighted price index, but you're often looking at a simple total volume figure. This means that lower-priced, but maybe very high-volume stocks, think penny stocks sometimes, or just very active lower-priced names, can end up having an unrepresentative higher influence on that total volume number. It distorts the true picture of the market's collective conviction, the actual money flow.
Ah, I see. It's like letting lots of tiny, noisy votes drown out the few really big, impactful votes in terms of where the money is actually committed.
That's a perfect analogy. You're not getting an accurate read of the conviction behind the stocks that are actually moving the index price.
So how do we fix that? How do we get an accurate, undistorted read of volume's real impact across the whole market, reflecting the conviction of those most influential players?
Dormeier's brilliant solution, and it really is quite groundbreaking, is capital-weighted volume, CWV.
Capital-weighted volume. Okay.
What this method does is it proportionally harmonizes each index component's volume contributions with its respective capital price weightings. In simpler terms, it gives more weight to the volume occurring in the larger, more influential stocks, the ones that actually drive the index's price. It provides a far, far more accurate representation of the actual money flow, the real conviction driving the broad market.
Okay, can you give an example of how this makes a difference?
Absolutely. Let's go back to the flash crash example. Leading up to that event, if you looked at traditional simple total volume data for the market, April 16th, 2010, looked like just a typical down day, nothing too alarming.
Yeah.
But if you use Dormeier's cap-weighted upside-downside volume, which specifically tracks the capital-weighted volume in stocks going up versus stocks going down, that indicator actually crossed under its key 19-day and 29-day exponential moving averages on Monday, May 3rd.
May 3rd. That was 3 days before the flash crash on May 6th.
Exactly, 3 full days before. It was a clear early warning signal showing that beneath the surface, the real money, the institutional money in the big cap stocks driving the market, was already starting to head for the exits. Traditional volume missed it. Cap-weighted volume caught it.
Wow. That's That's a seriously powerful early warning.
Mm.
It means you can potentially see the true institutional sentiment driving broad market trends, not just a distorted tally skewed by less important stocks. That feels genuinely groundbreaking for anyone trying to understand macro market moves. What a deep dive this has been, seriously. We've journeyed all the way from the basics of price versus volume through that fascinating history of market analysis. We explored Dormeier's really powerful indicators like the VPCI and especially that capital-weighted volume concept. And we even navigated the complexities of today's modern market structure. I think it's clear now for you listening, volume isn't just some secondary number on a chart. It's really the market's pulse. It's truth teller.
It really is. Ultimately, volume analysis provides you with the superior view of the market's internal structure. It helps you gauge the velocity, the force, the conviction behind the supply and demand that truly drives prices. It's fundamentally about empowering you to make more objective, more data-driven decisions by actually listening to the market's real voice, not just the surface noise.
And if, as Dormeier suggests, volume is the cause and volume leads price, then truly mastering this often overlooked dimension, well, it might just be the single one thing you need to figure out for a more informed, more disciplined investment journey. Because after all, as many great traders have said, it's often not so much the specific securities you pick that will make you rich or poor in the long run, but the process you employ consistently.
Which really raises that final important question for you. Armed with this understanding, how will you begin to integrate volume analysis into your own process? How will you use it to gauge the market's true intentions and navigate your investment path just that much more confidently? We definitely encourage you to continue exploring these concepts, maybe dig into the book itself, and check out the resources Dormeier provides over at volumeanalysis.com.